Welcome back to the deep dive. Today, we are taking a really focused trip into a corner of the European investment world that is, well, it's both highly specialized and absolutely booming. We're looking at institutional real estate for the life science sector.
Right.
And our mission today is to decode the, frankly, complex financial vehicles used to channel billions into this space. We're talking about European life science property funds.
And these are not your typical building.
No, not at all. These are high-spec labs, GMP facilities, regulated R&D centers all across the continent.
And that's the key distinction. When the big institutional players, pension funds, sovereign wealth funds, look at this asset class, they need a very specific kind of vehicle.
Okay.
They're typically looking for closed-ended or maybe semi-liquid funds, and they're almost always structured out of Luxembourg. The goal is stable, long-term income, and, of course, capital growth.
So that's the first big question for you, the listener. Why Luxembourg? I mean, Europe has plenty of financial hubs. Why has Luxembourg become the sort of default platform here?
It really boils down to a triangle of critical features. You've got a mature legal system, very specialized tax efficiency for assets that are cross-border, and the big one.
Let me guess. AIFMD.
The AIFMD framework. That's it. It stands for the Alternative Investment Fund Managers Directive.
Right.
And for a professional investor, what this really means is the fund gets a regulatory passport.
A passport, so it's trusted everywhere.
Exactly. Once it's authorized in Luxembourg, it's recognized across all 27 EU nations. And that just massively simplifies raising capital and buying assets in, say, Germany, France, and Denmark all at the same time.
So it reduces the friction.
It reduces the execution risk and allows for true pan-European scale.
Okay, so we know where the money is managed. Now let's talk about what they're actually buying. You said these are regulated facilities. How different is life science real estate from, I don't know, a standard office park?
Oh, it's a different universe.
Yeah.
Exponentially different. Yeah. Standard offices are driven by headcount, right? How many desks you can fit in. Life science real estate is driven by regulated, high-stakes activity.
Like biotech, pharma, that kind of thing.
Exactly. Biotech discovery, pharmaceutical manufacturing. These things require certified biosafety labs, ultra-pure water systems, specialized HVAC, things you just cannot retrofit into a standard office building.
And this is where the economics get really interesting, and I think this is the big aha moment for anyone looking at this sector. It's this concept of sticky tenants. We're seeing lease terms of 10, sometimes even 20 years. Why on earth are these tenants so difficult to move?
It comes down to, well, operational necessity and just layers of regulation.
Okay.
Imagine you're a big pharma company. You have a clean room, a critical manufacturing line. Moving isn't just packing up boxes. It is an operational nightmare.
Because you have to get everything recertified.
You have to revalidate every clean room. You have to move and then recalibrate multi-million-dollar equipment. And then you have to get all new regulatory approvals from the European Medicines Agency or the local health authorities.
Oh.
The time, the cost, the risk, it all means they're just hugely incentivized to stay exactly where they are.
And that immobility, I assume, is what creates the predictable cash flows everyone wants.
That is precisely what underpins the stable, predictable cash flows that these funds promise their investors.
And if they're not moving and demand for this space is growing, you get scarcity.
Especially in those big innovation clusters, right? The Golden Triangle in the UK, Paris-Saclay, Basel.
Exactly. Supply is just inherently constrained in those key research hubs. Land is scarce, and the cost of entry is astronomical.
So let's put a number on that. You mentioned the cost barrier.
We need to talk about the fit-out costs, just to get the inside of the building ready. It can easily exceed 3,000 euros per square meter. 3,000 euros per square meter. Just for the fit-out. I mean, to put that in perspective for you, that's way more than fitting out a premium bank headquarters.
It is, and it acts as a huge financial moat. That staggering cost discourages non-specialist, speculative developers from even trying to enter the market.
So it protects the value of the existing buildings.
It does. It supports rental growth, and for the investor, it means you're getting exposure to these essential high-growth ecosystems. You're diversifying away from troubled sectors like traditional retail or office space.
And you get that long-term tenancy with low vacancy and rents linked to inflation.
It's a very, very compelling defensive strategy in today's market.
Okay, so we've established the why these assets are so stable and valuable. Now let's get into the how. How do you package this all up into a vehicle that the world's biggest institutions will trust? Let's dive into the three main Luxembourg structures.
Right. And they each represent a trade-off, really, between flexibility, speed, and corporate governance.
So where should we start?
Let's start with the most flexible one, the SCSp. That's the Special Limited Partnership.
Okay, the SCSp. Why is it so popular for real estate?
Its governance is dictated almost entirely by one document, the Limited Partnership Agreement, or LPA.
So it's bespoke.
Highly bespoke. It means the sponsor, the fund manager, keeps maximum control over the rules, the fee structure, the carried interest they earn, everything.
It sounds tailored. But what about taxes? I mean, you're buying property in France, Germany, the Netherlands, all through this one fund. How does that work?
That's where tax transparency becomes key. For any real estate outside of Luxembourg, the SCSp can be structured as tax transparent.
And the simple takeaway for the listener on that is?
It means you avoid the risk of double taxation. You're not paying tax once in Luxembourg at the fund level, and then again on the property in, say, Germany.
I see.
It lets you use local holding companies, what we call SPVs, to handle local tax efficiently without making the main fund overly complex. It's great for value-add or development strategies where you need to move fast.
Okay, so if the SCSp is all about flexibility, the next one, the RAIF, that sounds different. The Reserved Alternative Investment Fund. That seems to be more about speed.
Precisely. The RAIF was designed to be fast to market. And the key reason is that it does not require direct product approval from the CSSF.
The Luxembourg regulator.
Correct.
So if it skips that big regulatory approval step, doesn't that make the big institutions nervous? I mean, where does the accountability actually sit?
That's the clever part of the RAIF structure. While the fund itself isn't directly approved, it is required by law to appoint an external, fully authorized alternative investment fund manager,
Yeah.
an AIFM.
Ah, okay, so the oversight is delegated.
It's delegated to the AIFM.
Yeah.
That manager is fully on the hook for risk management, valuation, compliance, all the reporting under AIFMD, and that's why institutional investors are comfortable with it. The oversight is still there.
And the RAIF also has this multi-compartment feature, right, for separating risk.
Absolutely. You can think of it as different buckets inside one fund umbrella.
So you could have your stable income-producing labs in one bucket.
In one compartment, yes, a low-risk portfolio.
No.
And then you could put a brand new, higher-risk development project in a completely separate ring-fence compartment. It just makes reporting and risk management so much cleaner.
Okay, that makes sense. So that brings us to the third option, the big corporate vehicle.
Right, the SICAV-RAIF. It's an investment company with variable capital, but it operates under that same fast RAIF regime.
And this is for the really big platform.
Typically, yes, very large multi-investor platforms. And here, the choice really comes down to the style of corporate governance you want.
So what are the options there?
You could choose the SA form, the Société Anonyme. That's a classic corporate structure with a board of directors. It's very familiar to global institutions.
The standard model.
Exactly. Or you could opt for the SCA form, the Société en Commandite par Action. Now, this is a bit more complex, but it gives the general partner much stronger, tighter management authority.
Which would be useful for?
For when you need absolute control over the execution of, say, a huge multi-phase lab development project where the stakes are incredibly high.
So whether it's an SCSp or a RAIF, the big goal is the same. You're trying to achieve tax neutrality at the fund level for all that real estate outside of Luxembourg.
That's the architecture. The fund in Lux handles the overall control, the AIFMD reporting, while the local SPVs in each country manage the specific property tax issues right where the lab is located. It's how you manage that European complexity.
That's a great technical blueprint. So for a sponsor listening to this, they have the structures, but what's the actual path from that blueprint to owning assets? What's the execution roadmap to launch one of these funds?
It's a very meticulous, multi-step process. Due diligence is everything.
It always is.
First, you have to clearly define the strategy. What are you buying? Core, stable labs, or riskier development projects? Which specific research clusters are you targeting? And what's the risk profile you're promising investors?
And only after that can you pick the vehicle.
Only then do you select the right legal structure. The flexible SCSp, the fast RAIF, or that SICAV-RAIF corporate shell.
And as soon as that's decided, you have to build the whole ecosystem around it in Luxembourg, which seems like half the battle.
It really is. Step 3 is appointing that entire suite of institutional service providers. The external AIFM, the depository bank to safeguard the assets, the administrator for accounting, the auditor, and your specialist legal counsel. That ecosystem is what gives you institutional credibility.
And the due diligence on the actual assets must be intense, especially with regulated buildings. You're not just buying bricks and mortar.
That's a key point. You're acquiring regulatory compliance. So before you close any deal, you must confirm that the labs or manufacturing sites are fully compliant with all the local health and safety regulations.
While at the same time, you're finalizing the tax structure.
Simultaneously, yes.
Yeah.
You're designing the local SPV structures and getting confirmation from lawyers in every single country that your fund-level tax neutrality holds up.
Okay, so documents are drafted, providers are on board. Then what?
After all the legal docs, the LPA, the offering document are ready, and the AIFM onboarding is done, the sponsor can finally start raising capital commitments. And this is where that AIFMD passport becomes so valuable for fundraising across Europe.
And once the commitments are in the door.
Then the real work begins. Issuing capital calls, closing on those first acquisitions, and implementing the asset management plans. And that often involves complex construction management to make sure the labs stay compliant.
So it's not a one-time setup.
No, it's an ongoing process. You have constant AIFMD reporting, investor communications, annual audited accounts, all to maintain that institutional trust right up to the very end, to the planned exit strategy. It's high-level asset management and constant regulatory compliance.
So to recap this deep dive for you, we've established the assets themselves. These labs and GMP facilities are high-spec, they're scarce, and they are incredibly expensive to fit out.
Which creates those powerful, sticky tenants with multi-decade leases.
We learned how the AIFMD framework and that whole legal ecosystem in Luxembourg make massive cross-border deals possible by really reducing the regulatory friction.
And we detailed the structural choices. The flexible SCSp for tailored, quick execution. The fast RAIF, which uses an external AIFM for speed and oversight.
And the SCAV-RAIF corporate shells, which offer that familiar corporate governance for the biggest platforms.
At the end of the day, Luxembourg provides the mature, legal, administrative, and cross-border expertise that these big institutional investors absolutely rely on to manage the complexities of this sector.
Which leaves us with a final thought for you to consider. Given the highly specialized nature of this real estate, where demand is driven by non-discretionary science and is deeply aligned with long-term government and EU research priorities, how might this niche sector's high barriers to entry and deep tenancy stability position it to withstand future market volatility far better than traditional commercial real estate? What does resilience really look like when your tenants literally cannot afford to move? Something to mull over until next time.